Hello traders, Gary Wagner here just after 10:30 in Honolulu, 4:30 in New York. It is Wednesday, 3rd day of April, 2017, and this is the Daily Report for Gold and Silver. Fed Day does not cease the tremendous sell-off that we have witnessed over the last couple of weeks in the precious metals complex, with major selling occurring today across the board in the precious metals. Gold trading off about 1.5%, 1.46 as we look at pricing right now, down over $18 when we look at most active futures, trading at $1238.70. 36.40 is the low on the day, so we're just a couple of dollars off the low. This sell-off really accelerated over the last, say, hour and a half. High on the day, 12.57, but that's something we haven't seen since trading much earlier this morning, late last night. And as I said, a pretty severe sell-off of about $18 on the day. $18, $12.38 in spot and most active June, pretty much coming into alignment. But the major selling today really occurred in silver, platinum, and palladium. Silver off over 2% on the day, 1648.5, a 35-cent drawdown. The low on the day is 1641. So we are just coming off of those lows, and 1689 on the high side. We also saw platinum and palladium erode in double-digit numbers, both trading off over 2% on the day. So traders, there is absolutely no doubt an extreme sell-off in the precious metals complex overall. Gold faring the best in terms of percentage drawdown, but nonetheless a major sell-off occurring in the gold market today. Currently trading off about $18, almost a 1.5% drawdown, and we're currently at 1338. We're looking at a daily chart, standard candlestick format, and what we're looking to ascertain is whether or not today's move has caused on a technical basis any major chart damage, and the answer to that has to be yes. We are looking at this single drawdown candle, and we are looking at it in relationship to two moving averages, our 50-day moving average, which is this dashed line here, our 200-day moving average, which is this solid red line here. We saw both of these moving averages kind of moving closer together. You can see that right here when you look at the distance between the two, especially when we hit the highs of the year here. And then the distance between the twos recently, we can see that they have absolutely been closer and closer. In fact, I had been looking for what is simply called a golden cross. A golden cross would be a scenario in which, and I'm going to need to obviously change my pointer to do this effectively, but it would be a scenario in which this shorter term moving average crosses above the longer term moving average, and then this move right here is simply called a golden cross. Well, we're far from that. In fact, because they are separate, we could in fact see something like a dead cross as occurred right here. But for the time being, the key to acknowledging the recent damage in this market is pretty simple. We effectively broke below both the 50-day as well as the 200-day moving average, and that to me says major chart damage, and that's the potential for lower pricing. Which brings us to our next chart. This, of course, is a weekly chart, standard candlestick format. And here we're attempting to look at potential levels of support in the market. And these, of course, are Fibonacci based on one hand. And on the other hand, we're looking at various highs and lows in the market, such as this high at 1297, of course. And then we are running a basic fib retracement, the longer one coming from about 1124 up to the yearly high at 1297, and there we have our various levels. Those are indicated over here on the left. We then have one shorter term of fib retracement, which is really the range of this last rally, starting just below 1200, taking us also up to this yearly high at 1297, and then those fib retracement levels are expressed here on the right. When we do that, the only real strong or area I can say where we do get some harmonics. And a harmonics is simply two different cycles coming up with the same price point or the same conclusion. We have a 38% retracement at 1231, a 50% retracement at 1228. They're not that far apart. And so what that tells me is that is a logical place to look for potential support in the market. Call it roughly a 1230, 1231 in the market. That's the next real level that this market could go to. Now, today's lows, of course, came in around 36, so we're still a little bit shy of that. And if you notice, the lows today match up with the shorter of these two retracement points, which is 1236.80, and that is a 38% retracement area. We are flat, will remain flat, but these are the areas that we would look at for potential support in the market. So traders, silver has been a different animal altogether, selling under much more severe pressure in the marketplace. On this particular chart, we are looking at a daily silver chart. We have one strong fib retracement, which starts at the yearly low, the rally which began at the end of last year, and it takes us up to the current yearly high, which is well above 1850. I believe it's around 1868. 1865, actually, that's the area where we cap it out. Now, when we do that, we get a couple of levels, and one of the key levels that you always want to look at for a long-term move is a 61% retracement. When we draw our line across, we can see that that does match up pretty eloquently with these lows that were achieved mid-March, and we also noted as recently as yesterday that the close, although slightly below, was below that 61% retracement. Now, today's move puts the next level into real easily achievable range, which is a 78% retracement at 1638. The lows today came in close. They were around 41, but this would be the next logical point. Now, a break below this negates almost all bullish models that we have. You can easily make a case for a market rising $1 and then retracing up to 61% and then rising again as being a bullish model as long as you get a higher low and a higher high. However, the next level below 61 is 78, and any breach of that 78 really takes away most models that we look at in terms of potential, not so much support, but the potential that what we're looking at is a series of higher highs and higher lows, or a marketplace that is in bull mode. That would come into question, but we haven't breached that point yet. About the only thing that we've effectively seen move up is the gold-silver ratio. And traders, we're looking at a daily chart of the gold-silver ratio. We've been looking at it on and off for the last week, week and a half, because I really had believed that we would see a widening of this ratio, meaning that it would take more ounces of silver to obtain 1 ounce of gold. We are now at 75.2. In other words, it takes 75 plus ounces of silver to buy a single ounce of gold. If you look at it as recently as the beginning of this month, or the beginning of last month, excuse me, it is May, you could have taken 68.5 ounces and obtained an ounce of gold. Now, for that same ounce of gold, it runs at around 75. My sense is that as long as there is downside pressure in gold and silver, we will see silver fall in terms of a percentage drawdown to a greater degree than gold, and that will make this ratio widen, and I believe that we could see more of that as long as we continue to see a fall in both gold and silver pricing. In other markets that we look at, of course, this was Fed Day. The Fed came out and announced that they were going to keep interest rates steady. We had the Dow Jones Industrial Average, which had been under pressure, trading nominally lower on the day, closing up slightly fractionally higher at 20,957. That is an 8-point rise. I will call that fractionally unchanged on the day. S&Ps did close lower on the day, but a fractional change at 2388. And the NASDAQ, which is absolutely on fire over the last couple of weeks, moving to new contract and all-time record highs, did sell off in terms of percentage drawdowns to the greatest degree, off 22 points, about 1/3%, almost 0.4% at 6,072. A dollar did gain some strength as we looked at it in the close at 99.21, and crude oil bucked the current trend, which had been going lower, to now, in fact, close basically fractionally unchanged on the day. It was trading a little bit higher earlier in the trading session. So, traders, a very interesting reaction to the statement that was put out by the Fed today, when in essence they had done exactly what the majority of analysts and market participants believed would occur, which is that interest rates would remain steady, there would be no rate hike, there would be a definite possibility for a rate hike in June, which was really illustrated in the wording of the statement today. And the biggest concern, of course, was that stealth rate hike, meaning how they're going to deal with their balance sheet, because for the first time in history, they're talking about liquidating components of that balance sheet. And that creates a lot of uncertainty in the market. Not a lot was really discussed about that, although that was a one or two liner in the statements itself. But that needs further discussion, and it certainly needs the Fed to really lay that out in a way to avoid having a lack of transparency in what kind of moves they're looking to do and what type of effect they're trying to achieve. Now, in terms of the NASDAQ, we saw that composite, that index, actually close off almost 0.4%, losing about 22 points. Not any major concern, but if you recall from yesterday's show, what I talked about was the fact that on a technical basis, and this is a weekly chart, we've got this major gap that occurs where there is a price void in between where the market was trading at 3 weeks ago, which was 5,900, and then this jump just below 6,000 before last week, breaching that milestone and trading for the first time in history above 6,000. It's managed to hold that. This week, it managed to have a series of new higher highs, which are new contract or record highs in the marketplace. And we seem to have stalled at 6,100. I believe 6,102 was the high yesterday. High today, 60.76. So we had a lower high. But most importantly, we have a doji. And the doji, of course, is an indication of a consolidating market or a market getting ready to pivot. What it says more than anything else is that neither the bulls nor the bears have absolute control of the market, and by virtue of that, neither of them can push it either positive or negative, and that therefore you get that unchanged price. It is something that you will see occur in both consolidating markets and pivotal markets. So we can look at, for example, this doji here, which comes in after trading sideways for a little while, and then you get this small retracement. You can see that right here too, a small retracement. Here you get a doji right before a small retracement. However, you will also get them in a market that is highly consolidating, such as right here. I'm trying to not move my pointer or our marks to these dojis, but here's a small body candle, not really a doji, but doji-esque. And here you get the market, which is small incremental moves here, but it shows that the market is consolidating before returning to its overall direction. So one doji does not mean a market top, but it does mean that it is time to look at that real potential of a small corrective move in the NASDAQ index. So traders, as you know, we have been flat with no active trades, now going on a week and a half, and I apologize for that. However, I have been looking to see if and when the current selling pressure that we see in the precious metals across the board would begin to subside, and we found some support. There's certain particular points that we look at, and they're typically Fibonacci based. Once we get close to that price point, we look at some sort of a pivot pattern to indicate that a key reversal is at hand. However, just because we hit a target price, a fib-based target price, such as the 23% retracement at 1246.90, call it 1247, that doesn't mean that we have seen a bottom in the market, but rather a place to look for a potential bottom. In the case of what we're looking at today, with the sell-off we're experiencing, where we've got about a $20 drawdown in the single day, as you can see, we've broken through a couple of real key levels in terms of where we're plotting potential support. The next level that we're looking at right now is a 38% retracement that falls roughly at 1236. Below that is the 50% retracement at 1228. Traders, continue to remain flat. I know that I do have long-standing subscribers that whenever we're flat, they're short in the market. If that's the case, you've done rather well today. We'll continue to look for a level of support. And as I said, right now, 1236 and then 1228 are current levels in gold. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.